Welcome back to Wall Street Podcast. Today, we're cutting through the noise, really diving deep into JPMorgan's latest global FX strategy report. This is their key currency views, why the bearish dollar view still holds. Peace. Just out July 11th, 2025. Our mission: to unpack why JPMorgan is sticking to this bearish dollar view, especially when, some signals might point the other way, and what it means for you.
Right, and that's what's so striking, isn't it? That contrarian stance. They're holding firm on the dollar weakness, really challenging some conventional indicators. So yeah, this deep dive is all about uncovering the cyclical and the structural factors behind that conviction, and of course the implications.
Okay, so JPMorgan's sticking to its guns, bearish on the dollar, even after the DXY, that's a US dollar index, tracking it against six major currencies. It's already plunged, what, a full 10% year to date?
A full 10%, yeah. It's actually its weakest first half performance since at least 1980, I believe. It's quite historic.
Wow. So what are the hidden drivers they're seeing? What's the market maybe underestimating, especially given that huge drop already?
Well, they're pointing to a kind of a potent mix. You've got cyclical things like U.S. economic moderation, maybe things slowing down a bit there, and crucially, this dramatic return of the tariff discussion. And alongside that, you have these structural elements, things like valuations, fiscal dynamics, policy uncertainty. So even with the dollar already down, they think the underlying story supports, well, more weakness.
Right. And speaking of tariffs, that risk has definitely resurfaced big time. JP Morgan details a whole flurry of recent announcements, doesn't it?
Oh, absolutely. Implementation dates pushed back to August 1st by Trump, new threats, 50% on copper, potentially 200% on pharma, even 35% on Canada.
And Brazil saw a huge jump, right? 50%.
Yeah, an outsized jump to 50% from 10% previously. It's significant. And the point JP Morgan makes is that if these actually hit these broad tariffs, the global growth risks, they're just not fully priced into markets yet.
Okay, so what does JP Morgan think the market's not pricing in here? And what's the direct hit on currency performance if these tariffs land?
The key unpriced risk, connecting the dots here, is that potential for a really significant global growth shock. They state it pretty explicitly. Broad and large tariffs are fundamentally USD negative. Think about it. They see it as inflationary for the US, but deflationary for the rest of the world. That whole dynamic actually reduces the dollar's attractiveness, and it fundamentally shifts the focus, towards those traditional safe haven currencies.
Right, okay. So given this whole backdrop, this expected dollar path, where does JP Morgan see the opportunities in G10FX? Let's start with the euro. Their bullish euro US 3Q target 1.19, peak 1.22. That seems quite ambitious, pushing way past typical fair value estimates around, 1.01, 1.1?
Yeah, it is ambitious, and it's a real eyebrow raiser. But what's fascinating is that JP Morgan explicitly says the euro currently overshooting those traditional fair value estimates isn't actually a constraint for them. Their view, based on past experience, is that when you get these big structural or cyclical shifts happening, like now, these models can show really large persistent dislocations. They're looking beyond the short-term numbers.
So what are they looking at then?
They're focused on drivers like rate differentials turning more favorable for the euro, improved terms of trade, think lower energy prices, helping Europe and relative equity performance. These underlying fundamentals, they believe, mean the rally has more room to run. It's a structural story.
Okay, interesting. So from the euro's, let's say, surprising resilience, let's pivot, the British pound. The outlook there seems, much less rosy. JP Morgan downgraded GBP. What's the main drag they're pinpointing?
Yeah, the pound's downgrade is mainly down to weak domestic data coming through and renewed worries about the UK's fiscal situation. JP Morgan's highlighting a pretty clear step down in UK growth from Q1 to Q2, and they're looking at services PMI data suggesting a, quote, material step down in supercore services inflation.
Right.
That's the really sticky underlying stuff central banks hate coming in the second half of 2025.
Supercore, right? Always tricky.
Exactly. And then you add this looming fiscal hole, maybe 15, 20 billion pounds. Plus, even a recent speech from a key Bank of England MPC member, Ramsden, pointing to new highs and redundancies. It all just piles on the downside pressure for sterling.
Okay, so weakness in the UK. But for investors looking for safety amid all this uncertainty and potential tariff shocks, JP Morgan singles out the yen and the Swiss francs. Why JPY and CHF right now?
Right. They are explicitly bullish on JPY against the US dollar, and they're actually initiating new long positions in the Swiss franc CHF against a basket of GBP and EUR. And this ties directly back to that tariff-driven global growth shock scenario we talked about. The core idea is the market isn't fully pricing these risks in, creating, a clear opportunity for these defensive plays.
Makes sense. What about the specifics for JPY?
Well, for the yen, yeah, it's been a bit weak recently. Some position unwinding, maybe some fiscal jitters around the upcoming upper house election on July 20th. But JPMorgan's holding firm on their bullish USD JPY one-year target of 139. And they make an interesting point: Japanese auto exporters, they've apparently already significantly cut export prices, sort of proactively absorbing potential tariff hits.
Getting ahead of it. And the Swiss franc.
For CHF, it's about its strong fundamentals. Solid fiscal metrics, strong balance of payments, these provide real support. Now, the SNB, the Swiss National Bank, has reportedly been intervening, maybe selling around 15 billion francs in June.
Trying to cap the strength.
Exactly. But JP Morgan's view is that those interventions probably won't be enough to significantly offset the franc's appreciation if these global growth risks really escalate. The safe haven demand could overwhelm it.
Got it. What about the Nordics, NOK and SEK? How do they fit into this picture?
Still bullish on both, actually. For the Norwegian krone, and yes, there was that surprise Norges Bank rate cut in June, but JP Morgan basically sees any weakness from that as a fade, a buying opportunity. They view Norway as pretty uniquely resilient to global trade uncertainty. It's got healthy fiscal space, still offers a high yield. And the Swedish krona, SEK, is also expected to benefit from lower global yields tied to that U.S. moderation story, plus its own strong fiscal position, even with some recent domestic growth hiccups.
Okay, lastly for G10, the commodity currencies. CAD, AUD, and ZD.
Yeah.
Sensitive to global trade, right? So what's the take?
Yeah, they are sensitive. For the Canadian dollar CAD, the view is kind of cyclically wary but structurally encouraged. It's actually been the worst G10 performer outside the US dollar so far this year.
Really? Why is that?
Heavily impacted by those trade war threats, including that recent 35% tariff threat specifically on Canada. But longer term, they see positives like fiscal support, a potential U.S. economic pact providing tailwinds. And here's a key point. Canadian pension funds, their FX hedge ratios, especially against the US dollar, are apparently remarkably low. That leaves a lot of room for increases, which would be a big support for the CAD.
Interesting structural point. Okay, Aussie dollar, AUD.
AUD fundamentals suggest a grind higher. They have a year-end target of 0.68. The RBA, Reserve Bank of Australia, has been sounding quite hawkish recently. Their gradual easing cycle is seen as supportive for rate differentials. And notably, Japanese investors were actually net buyers of Australian fixed income back in May. First time this year. It's tentative, but it hints at potential, de-dollarization flows starting to emerge.
And the Kiwi, NZD.
NZD looks poised for a cyclical recovery. Domestic consumption seems to be driving growth, and its low trade share with the U.S. makes it less directly exposed to the tariff noise. The RBNZ, Reserve Bank of New Zealand, held rates steady in July, but the overall outlook for rate differentials, business sentiment, it's looking increasingly supportive for the Kiwi dollar.
Okay, that covers G10 pretty thoroughly. Let's shift to emerging markets. JP Morgan is, quote, tactically neutral on EMFX, but medium-term constructive. That sounds like a bit of a balancing act. What does that mean in practice?
It is a balancing act, yeah. The tactical neutrality comes from their own EMFX risk appetite index hitting overbought levels. Basically a signal that maybe speculative positioning got a bit stretched, ripe for a near-term pullback perhaps. But structurally, looking medium-term, they see EMFX entering a more positive phase overall.
So where are the key stories within EM then?
Well, for MXN, the Mexican peso, and BRL, the Brazilian real, they've actually moved to neutral from overweight. They're acknowledging those overbought signals. I mean, MXN is still up around 11% year-to-date, supported by high real rates, though remittances are apparently deteriorating a bit. For BRL, even with that 50% tariff threat, Brazil's trade ties with the U.S. aren't huge, so the impact might not be long-lasting, and the carry trade there remains attractive.
Okay, so neutral on those two. Where are they overweight?
They remain overweight the Turkish lira, TRY. Reasons cited are high nominal and real implied yields, cleaner international positioning, and signs that dollarization pressures within Turkey are subsiding. Also overweight the South African rand, ZAR, that's benefiting from precious metals doing well, plus a projected lower inflation target in South Africa should improve its real rate profile. And in Central and Eastern Europe, the Hungarian forint, HUF, is singled out as their favored bullish pick. Supportive local story there.
Any other quick hits in EM?
Yeah, a few. Chinese yuan, CNY, forecasts unchanged. China was notably excused from the latest tariff hikes, which could open the door for more relative strength versus other currencies. Korean won, KRW, looks constructive fundamentally, but they're tactically sidelined just due to rising short-term risks. And the Indian rupee, INR, still has a positive macro backdrop, even if capital inflows have been a bit slow lately.
Right. Now, this brings us to something really crucial, I think. JP Morgan openly acknowledges that some of their own systematic models, like their growth momentum model, that EMFX risk appetite index you mentioned, have actually turned less USD bearish. Some are even turning bullish on the dollar. Yet their core conviction, their main call, remains firmly bearish on the dollar. For our listeners, how do they justify essentially overriding their own quant signals? What's the argument that trumps the data here?
Yeah, this is where it gets really interesting, and it's about perspective. JP Morgan's stance is basically rooted in recognizing that we're likely in the midst of significant structural and meaningful cyclical changes. You could call it a potential regime shift in the global macro landscape. And their experience tells them that in these kinds of environments, systematic models, which are often based on historical relationships, can show these persistent dislocations. They can even throw off, false signals because the underlying economic relationships themselves are shifting.
So the models haven't caught up to the new reality yet.
That's essentially the argument. So while tactically, yeah, you might look at the signals and expect some short-term dollar consolidation, JP Morgan's medium-term view remains anchored to this bigger macro-structural story. The context matters more than the short-term model noise in this specific environment.
Okay, that makes sense. Looking beyond the models then, back to the tariffs. We talked about the direct currency impacts, like for JPY and CHF. But what about the broader risks? What are the big global growth and inflation risks from these tariffs that JP Morgan thinks the market is still not fully pricing in? How might that ripple through a portfolio?
Right, connecting it back to the bigger picture. The key unpriced risk they highlight is just how onerous, that's their word, the global growth impact could be. Remember, they see these tariffs as inflationary for the U.S., but deflationary for the rest of the world. Now, that implies a potentially significant divergence in real policy rates and economic paths globally, something they believe markets are really underestimating right now.
And for a portfolio?
Well, for a high-level portfolio, that translates into potentially underestimated stagflationary risks inside the U.S., slower growth, higher inflation, which would pressure real yields and the dollar. But it also means a very different inflation picture elsewhere. So the implication is you might need to hedge against broader growth slowdowns outside the U.S. more actively, maybe favoring currencies from economies with strong external balances, good fiscal health, not just looking at direct trade exposure. It's a call to diversify risk hedging.
That's a critical point. So given this expected dollar weakness, these ongoing structural shifts, potential de-dollarization, FX hedging changes we discussed, which specific currency plays, maybe beyond the obvious safe havens like JPY and CHF, offer the most compelling strategic value, thinking longer term for sophisticated investors.
Yeah, beyond the immediate safe havens, they do highlight several others driven by these broader themes. Look at the euro again. They argue that significant FX hedge rebalancing, I think large European holders of U.S. equities eventually hedging some of that dollar exposure back into euros, could provide persistent bullish pressure, almost independent of tactical overshooting. That's a structural tailwind.
Okay, euro for structural reasons. What else?
Consider the Australian dollar, AUD. It benefits from strong fiscal capacity, those positive rate differentials we mentioned because the RBA is moving gradually, and those early signs of Japanese investors buying Aussie bonds. That could be part of a bigger de-dollarization theme playing out over time.
Right, the Japan flow.
Exactly. And even the Canadian dollar, CAD, yes, it's got near-term tariff worries, but those structural tailwinds, fiscal measures, and especially the potential for Canadian pension funds to significantly increase their very low FX hedge ratios, that's a multi-quarter story that could drive sustained appreciation. So for the high-knowledge investor, these currencies stand out because their potential strength isn't just about the next few weeks or months. It's rooted in these deeper rebalancing acts and policy shifts that could offer strategic value.
Fascinating. So a lot to unpack there from JP Morgan's rather contrarian view. What really stands out to you from this deep dive? It seems the core message is to look past the short-term noise, the potentially misleading signals, and position for a more fundamental shift away from the dollar. How might that challenge your own assumptions about reading the market? Something to think about. Keep exploring, keep learning. We'll be back soon with another deep dive.